my name is Jesse Durham. I very much feel like I'm back in the classroom because I plan on using the whiteboard. I'm here to teach you how to live and leave a lasting legacy through infinite banking. So by all means, if this is your first time meeting me, I would encourage you to get a hold of this book that's called Becoming Your Own Banker by R. Nelson Nash, this gentleman right here, or to watch a full introductory presentation on my channel, durhamtalents.com, or of course you can find it right here on YouTube to get an introduction to what I mean when I say infinite banking, okay? But I've had a lot of great conversations here recently with some professionals in the space, with clients and with prospective clients as it concerns, okay, so I'm assuming that you know some things about infinite banking. Again, if you need to, go ahead and get this book. Come back to this video. I would encourage you to watch my full introductory presentation video. It takes less time to watch that than it does to watch a Marvel movie, and it will teach you how to live and leave a lasting legacy. Okay, I teach people how to keep their hard-earned money. All right, so what I would like to do is talk about how to manage premiums, policy loans, and then profits. And I do plan on using some whiteboard, so I'm going to be trying to monitor the chat. If you have questions in general about infinite banking, about me, about what I'm teaching here, feel free to put that down in the comment section below. But I'm going to try and address some things right here. Okay, so let me just lay out a scenario. And I know I'm breaking one of the cardinal rules by tactically speaking and communicatively turning my back so that I can, and if y'all would, sound off for me. This live experience, this is something that I've been doing every week for a little bit. If you would put where you're coming in from on this live or on the replay, and of course, again, if you have a question, I'll get to your question. But I'm going to be turning my back here, but I'm going to be monitoring the chat as well so I can address your questions. Well, let's talk about this. The marker that works. Infinite banking, and again, particularly as it concerns, okay, premiums, policy loans, and profits. So what infinite banking is, let me start with that. What infinite banking is, this book is a paradigm, a philosophy of you becoming your own banker, okay? You controlling and you profiting over the banking function in your life. Now, when it comes to banking, I've got a real simple explanation for you. A bank is simply something, some place, some entity where something is deposited, okay, placed, put, and it's a place where you would take from as well, okay? So think of a food bank. You can't have a food bank unless you put food in the bank. That makes it a food bank. But of course, the purpose of a food bank is to be able to have a place where you can get access to food. So a bank is simply a place where you can put money, have access to money, and then hopefully there are some other advantages that take place there. But now see, conventionally, when we put money in commercial banks, well, see, that's a business, and there's an owner of that business. And it's the owner who then controls our money when we put our money there. And banks are out making bank with our money. See, because they're making all these loans with our money to other folks for their homes and cars and educations and vacations and everything else. So it's a very profitable business. If you ever question that, just look at how beautiful the buildings are, how well kept the grounds are, okay? Banking is a fantastic business, and that's what it looks like conventionally done. Well, when people catch on to this philosophy, this paradigm of, well, I'm going to become my own banker, I am going to systematically begin putting some money in a place where I have control, where I have ownership, where I have access to capital, okay? And there are lots of advantages here, but I do want to get to talking about how to use this banking system and how to manage the various cash flows to and from the banking system. Okay, so let's start first by talking about, well, in conventional banking, it's deposits. Deposits are money that we put in the bank that we plan to use later. Okay, with a properly structured whole life policy from a mutual life insurance company that pays dividends. That is the entity that Nelson talks about in his book, and that is what I've personally done in my life. Here's a great chance for me to be able to say, to date, I own 7 policies so far. So I've implemented this concept for right at 10 years in my own personal life. My wife and I, we have 3 children, 4th one on the way. We have been building a system of policies, much like banks open up multiple branches right there in your town corner, just like they're in my town's corner. And we've privatized banking for ourselves going on 10 years or so now by buying those properly structured whole life insurance policies from mutual life insurance companies that pay dividends. So I'm saying something very particular there. And again, if you've not seen my introductory presentation video, start there, come back to this. You don't have to leave right now, but I'm saying you should watch that next. Read this book to know more about why I talk about policies being the ideal way to privatize your banking system. I mean, there are lots of reasons. It's a very old financial product. It's a very reputable financial product. It's got guaranteed growth, guaranteed access to capital. You can enjoy dividends. These companies have been paying dividends for well over 100 years, these great, fabulous mutual life insurance companies. So there are lots of advantages to privatizing your banking just by having that ideal asset. But I want to talk about you managing the cash flows, okay, the banking of money going to a policy and money going from a policy. So when it comes to premiums, let's talk about premiums for a moment. Let's say that premiums in a household, and that's still kind of faint, but I'm going for 100,000 just to put a rough number out there of a household income. Household income. Okay, say somebody earns 30,000, somebody earns 70, somebody earns 50. Okay, so lots of homes, 2 incomes, $100,000. Now, the numbers don't matter. Numbers can be bigger, smaller, and they will be. I treat every individual client that I have, and I work with folks all across the country on a case-by-case basis. I just want you to understand some principles here. So let's say out of this $100,000 household income, you decide not to spend it all. Now that's actually a really big deal. See, the average American, whatever it is that they earn, the average American earns it and spends it. Average, okay? Nelson, in his book, points out the abysmal savings rate. So let me just go ahead and tell you that if you're not open to the idea, if you've not already started, saving some money, I can't help you, no one can help you, okay? And it's a human law that we all have to confront. There's a law in Nelson's book called Parkinson's Law, and it's that natural human tendency to earn what we earn, spend it all. That's just the natural human tendency, okay? What I want you to, of course, start from is savings, okay? If you're already saving money, if you have an emergency fund, if you have some contingency funds, if you don't spend all that you earn, let's start from there. Because if you're not going to do that part, I got a buddy, Bill, he says you got to do your own push-ups, okay? If you're going to save, I think we should talk about maybe how much, the ideal way to save or place to save, sure. So let's just, again, pick an arbitrary number. Now remember, we're talking about premiums here in a moment. Premiums to one of these properly designed whole life insurance policies that you're going to use as your family banking entity, your family bank, okay? So you might say, well, Jesse, let's start with 5% of my gross income towards savings, 10%, 20%. I don't necessarily care the number. I would say that if you throw out something like 2%, 3%, just ask yourself, is that really a sincere number that's going to help you move towards your goals of X, Y, and Z, whatever your financial goals happen to be? Is that really going to move the needle? Okay. And if you've not saved yet, or you've not started this infinite banking concept, You're certainly not going to start with all of your income. You're not going to be saving all of your income, although I'll plant this seed now. Nelson does say in the book that eventually premiums to a system of policies, notice how I said that, system of policies, can eventually and should eventually equal your income. Now, if that's a wild thought for you, hang around. Let's walk that out some more. But we need to find a starting point, okay? And I've got a few ways of going about finding a starting point on premium. I actually have a premium video that I could reference in the show notes when I'm done with today's live interaction. But let's say you just used some mathematical gauge like a percentage, okay? 5%, 10%. Another way you could go about it is, what are you worth per hour? Now just walk this math out with me. See, when I saw Infinite Banking back in 2015, I had somebody ask me, Jesse, what are you worth? And I knew what I earned at that time, and here's how I was asked. Jesse, are you worth $10 an hour? And I thought, well, yeah, I earn more than $10 an hour, so I'm worth $10 an hour. Of course I am. Okay? Are you worth $5 an hour? And then he even walked it down to 2.5. Okay, so let's just take the middle of the road. Let's say $5 an hour right there. Well, if you decided to pay yourself first, if you've never heard that principle, it blew my mind when I first heard it back in 2015. Pay yourself first. We are how we earn income, right? There are only two ways to earn income. Either people are at work or money is at work. Well, when I'm at work, okay, when we lay our hands to something and we adopt this principle of paying ourselves first, let's pin it to a number. $5 an hour? What does that come to? 8-hour work days, 40 hours a week. Multiply that by 50 out of the 52 weeks. Let's give ourselves 2 weeks of vacation from paying ourselves. It's $10,000. Okay? You can check me on the math right there. Okay? But if we said, well, I'm worth $5 an hour, 8 hours a week, or 8 hours a day, 40 hours a week, over 50 weeks, it's $10,000. So could we be talking about $10,000 of premium? Well, relative to this household income in this scenario that I'm just using for a basic example, okay, could we be talking about somebody that has a household income of $50,000 or $5 million? Yes, of course. Okay, move the decimal left or right, however we need to. Notice the principle here. I'm talking about premiums. Okay, well, once you figure out what's appropriate for you, okay, $5,000 in premium, $50,000 in premium, whatever the case happens to be, that's going to be the money that you are capitalizing in your policy. That's going to be where you decide to bank your capital to save your money. Now, I'm aware of more than a dozen reasons, a dozen characteristics as to why a properly structured policy, let me just give you a visual right here. I'm kind of a visual guy if you're not catching on to that. A policy is simply a contract. A policy is essentially, at the end of the day, a piece of paper, an agreement between you and this private insurance company where you're agreeing to pay premiums for this policy in exchange for a much larger death benefit. Okay? That's what this policy, this contract is doing for you. You're paying premiums, and watch this. Every time that you pay premiums, the policy appreciates. Its value goes up. Guaranteed. That's one of the attributes of this ideal characteristic, this contract, this life insurance policy that's been built a certain way with a certain company and it's being used a certain way. Yes. But every time that you pay a premium, the death benefit increases. So essentially, we're just saying that this entity that you own and that you're using as a privatized banking system is creating also a cash value that you can leverage. Okay, so one of the features of a whole life policy is that it has a cash value, and a cash value that grows, compounding, uninterrupted for your whole life. Hence why we use whole life insurance. Okay, so I've placed money in the policy as premiums. You pick the number that makes sense for you. Of course, over time, I have allocated more and more of our household cash flow to this system of policies. Because when I first started, and you can watch this, I've made a video about our debt payoff journey. I've got a life lessons series on my YouTube channel where I have shared what it looked like for us to pay off our student loans, credit cards, the family car, medical bills, lots of things. So feel free to check that out there. But we started doing that by getting our first policy. We decided that we wanted this private family banking entity, okay, where we could pay premiums, have a death benefit, that was protection, have a cash value that was going to grow and compound for the rest of our lives, where we could have access to money to go out and do things like pay off those debts, okay? So that leads me to talking about after premiums, okay? So let's say premiums is number one, okay, because you don't have a policy, you don't have a contract if you don't pay premiums, okay, just like you wouldn't have money in a commercial bank if you didn't make deposits, okay? So the second is going to be, well, when we go to access capital from our policy, we do that with policy loans. So this policy is appreciated. We've got a cash value in this policy that we can leverage. So we're going to take this, and there are a couple of things that we could do with a policy loan, right? Essentially, we could pay off something or pay for something. Let's talk about paying off, okay? Because I think I've covered enough about premiums. You let me know, okay, if I have. Do you have any questions about premium? One way of looking at premiums is, what percentage of our gross income do we want to begin directing towards this private banking system? You could also reverse engineer when you work with somebody who's going to custom design you a policy. And I do work directly with my clients, and they're all across the country. Directly with my clients, we can reverse engineer how we construct a policy based on your goals and your plans. What are some 12-month goals and plans that you have? What are some 12-year goals and plans that you have? What are some 12-generation goals and plans that you have? Okay, this is going to be an entity that you're going to own for your whole life. And remember, whole life insurance policy has a guaranteed death benefit. Well, where's that big windfall going to go? Well, to your heirs and your beneficiaries. And then that can begin to create an intergenerational private monetary system where they're getting, those heirs and beneficiaries, that income tax-free windfall right into their own banking system of more of these policies. Incredible to think about. But you could use policy loans to pay off something, is what I was describing. But it all started because we paid premiums. So did you have any questions about premiums for infinite banking? Let me know. Another way to think about how to pay premiums is that example that I gave of what are you worth? What are you willing to save? And here let me say there's a big difference between saving and investing. Notice I have yet to have said the word investing other than to point out here that I have not said investing. Life insurance is a risk management financial asset. Okay, you're actually taking the risk that you have, which is the fact that 100 out of 100 Americans die. Those are the statistics, okay? We're all going to graduate from this life into the next. We're all going to pass. We're all going to die. So I want to offset that risk that my family has on the insurance company. That's where I want to put it. I want to have that guaranteed windfall, that guaranteed death benefit for my family. So I have not said anything about investing. We're talking about the ideal way to save your money for the purpose of infinite banking, living and leaving a lasting legacy. So if you have any questions about premiums, make sure to put those in the chat. I'm going to try and monitor those. But let's talk about these policy loans. So again, my own example. When I took policy loans from my policy to go out and pay off the student loans, to go out and pay off the family car, to go out and pay off the credit cards that I'd run up. Remember, everything that I said about personal responsibility, you've got to decide on a couple of things. Number one, our choices, decisions, habits, okay? Are we willing to save and to keep some of what we earn to get this process started? And then, of course, there's just the question of efficiency, okay? Conventional financing keeps us in debt. The average American, watch this. Nelson says it in his book, Becoming Your Own Banker. He says that the average American, okay, average American is bleeding out about 34.5% of every dollar that we earn in interest alone. See those credit cards, those student loans, that car, all those things, we were bleeding out interest dollars that were forever leaving our family. Okay? So this policy allows us to enter our capital into a much uninterrupted growth, access, compounding. It's beautiful. But I took policy loans from my policy to go out and pay off the credit card. Well, when I pay off the credit card, okay, and I used to owe $50 a month, $500 a month, $5,000 a month, whatever it was. If I used to owe that to a third-party lender, but now I don't have to pay them anymore because I built up capital in my policy, leveraged my policy, paid that off. Where do you think that this monthly cash flow should go? Well, it should go right back into the system that was giving my family protection and compounding and access to capital in the first place. I can refill that reservoir back up where I had used some capital. I could refill that. And then, oh, by the way, that then means that the interest dollars that used to go towards those debts can also now go in here. So when it comes to policy loans for paying off something, I feel like most people get that. Again, if you have any questions about policy loans, put that in the comment section below. I'm watching this. Where I felt the rub here recently in conversations with several folks is when it comes to, let's say, a business implication. And I'll probably share this in my next Q&A series where I address people's questions. I had a gentleman comment on one of my YouTube videos where I'm talking about using a policy loans. And he says, well, if somebody takes out $40,000 in a policy loan to go out and pay taxes, don't they now have to pay premiums and a policy loan back? And how does that work? So I'd like to walk through that part. I feel like it's pretty simple for us to understand, well, okay, if I put capital in a policy, and then I also use a policy loan to pay off a debt. I don't owe that debt anymore. That money's mine to keep now. Done. But if I put money in a policy as premium, and then I also get to leverage capital from the policy to pay off some type of recurring expense. Okay, so let's say it's taxes, and this isn't advice of any kind. I'm just talking with you about how cash flows and how it can flow most efficiently by infinite banking and you implementing that concept in your life. Well, most people, let's say this same household, okay? Let's say they have a tax bill. We need new markers all across the board. See what I did there? Pun? All across the board. Let's say there's a $5,000 tax bill. And let's say that this household had decided on a policy where they were essentially funding 10% of their gross income or $10,000 in premium to the policy. Now, in the beginning, you don't have 100% of a $10,000 premium liquid because you're capitalizing what you really should think of as a business. So Nelson says this also in the book, that capitalizing a policy, starting a policy, deciding to pay premiums is much like starting a business. Okay? And if you're putting in, let's say, $10 in premium in the first year of a business, all right? So not as premium. Let's say you put $10 into a business. Well, if in year one you can get a new $5,000 out of the business. If the business could cash flow you $5 back, okay, and your $10 is still in the business, so to speak, in the equipment, in the employees, in the space that you have for yourself, whatever that happens to be, but it could cash flow a number to you, let alone something like half or more than half of what you first put into it. That's a pretty efficient business, especially considering that, 95% of businesses don't even make it in their first year, okay? And then if the next year the business lets you put in a new $10 and you could get access to more capital, let's say you got 70%, let's say you got $7 out of the business that year, then that's an even better year, obviously. So what I'm trying to say is when you look at a policy in the lens of a business, that is what's taking place most accurately. You're capitalizing. You don't have 100% liquidity in the beginning, but you can certainly have a significant percentage of liquidity relative to the premiums that you've paid. Meaning, if you paid $10,000 in premium, could you have access to $5,000 to go out and take care of your tax bill? Absolutely. Okay, so let's say then you go and you pay the tax bill off. Now, whether you do that quarterly or whether you do that annually, doesn't matter. But do a comparison here. If you were paying that $5,000 conventionally without a policy, didn't you have to save up through the year to be ready for that tax bill to pay your $5,000 in tax? Yes. This is just a more ideal place to do that, to save money. But now, does it take capitalization? Because you could say, well, Jesse, I only needed $5,000 to pay my taxes. True. But you're talking, Jesse, about putting 10% or $10,000 in premium and only getting access to $5,000. True. Remember how that business is working, though. So see, when you pay $10,000 in premium, that stays in the contract, and the contract appreciates how long? For your whole life, which again means that the more that you capitalize, the longer that you capitalize, the more often that you capitalize, this policy is going to get more and more efficient. And what ends up happening is you get to the point to where you're putting in a smaller number, and I'm just picking up random bills here, but you put in the same premium, let's say, that you always have, but you get access to more than you paid in premium. Okay, so it flips. In the beginning, you're in a capitalization phase. But I'm trying to show you too, though, that even in a first year policy, it is possible to design a policy in a way where the premium, which you choose, I don't choose people's premium numbers. My clients tell me how much premium they're going to pay. Now, I'm really good at looking at your cash flow, what I call your financial footprint, to find out where are the inefficiencies, okay? Because we want to be as efficient with our dollars as possible, okay? I mean, if we would have conventionally paid this $5,000 in taxes, how much of that money comes back to us once we pay Uncle Sam? Or isn't it gone forever? Whereas, if we would have capitalized that money in the policy first, and then used a policy loan to go out and pay those taxes, the taxes got paid, and we still own and control this appreciating asset. It just gets more and more efficient over time. And actually, it gets more efficient the more we use it. Remember banks, those beautiful buildings with the best kept grounds? Banks are super profitable. Again, I try to point this out in a clear and concise way in my introductory video at durhamtalents.com. I would encourage you to check that out. But here's where I think folks are mentally wrestling with policy loans, because the plan is keep paying that premium. Okay, so I'm going to pay that again next year. But then I've got this. So let me ask a question and point some things out. When it comes to taking a loan from a bank, let's say you're doing conventional finance to pay for your things. Well, you've got two options, right? You can use credit or you can use cash. If you use credit, you're going to a bank and you're asking them, will you qualify me? You got to fill out their paperwork. You got to pay them interest. They're going to hold probably some kind of collateral over your head, okay? And at the end of the day, when you pay that loan off, where are you at? Zero. The light at the end of that tunnel is zero. You've got nothing to show for it from the money. Also, if you just wanted to pay the taxes from your cash flow, how many jobs do those dollars do for you? You pay the taxes, okay, by paying cash, but then the cash is gone. That capital has escaped your reach. It's escaped what could have been a private banking system where your premiums would continue to grow and compound, which is going to lead to a rising cash value for greater and greater policy loans to go out. So again, whether it was me and my wife paying off that family car, or whether it's somebody paying off some recurring expenses like policy loans going to taxes that happen every quarter or once a year, banks have that ebb and flow. Banks have, commercially, those deposits and withdrawals. Or when we privatize it, they have those premiums and those policy loans. So if we were going to stage the next $5,000 anyway, if we had to pay $5,000 in taxes, if we didn't use a policy, doesn't it really then just ask the question, is it worthwhile to capitalize? Is it worthwhile to pay more than this number to be able to own an appreciating asset that we'll be able to use for our whole lives, where we can recapture? And again, here's the big one. Here's the big one. We could talk about taxes. We could talk about inflation. But let's again recognize that for the average American, which means some pay less, some pay a lot more, 34.5 cents of every dollar is being spent just on interest. The things that we're financing, we're bleeding out those interest dollars. Well, if you could keep that in your system, that's you being more efficient with the same dollars, that's you controlling. Okay, we haven't talked about this. If you have a loan with a bank, doesn't the bank tell you how much interest you're paying? And if you don't make that payment, they'll come and get the car or whatever it happens to be. When you take a policy loan to go out and pay off Uncle Sam, you own the policy. You get to decide, okay, pay my taxes. I get to decide now when I'm going to pay this back, how much I'm going to pay this back, or even if I'm going to pay it back. Now, that's not advantageous. We should pay it back. We would have staged the $5,000 for next year's taxes anyway, so we should. Again, we're just changing the place. So, see, that's really all that's happening here, is you're really just changing one thing to what you're already doing. You're already banking. You're just doing it at commercial banks where you're not the owner and you don't profit. You don't control it. This is your private banking system. You own it. You control it. Any questions about policy loans? Anything at all? And again, if you're seeing this on a replay, I'll come back. I will answer your questions. I'll move on to this last, which is profits. Okay, managing more cash flows, because lots of folks will say, well, Jesse, I only want to use my policy loans for business and cash flowing assets, investments, etc. Great. The idea of you becoming your own banker is you becoming your own banker. So if you capitalize money in a policy, and then you leverage your policy, okay, which is the most ideal appreciating asset. It's beautiful. You can have that uninterrupted compound growth while still having uninterrupted access to capital. And you go out and you make an investment of some sort, okay? Whatever that happens to be. Your business. I work with plenty of business owners, okay? Invest in yourself. Invest in your business if that's what you choose to do. Great. I'm not making investment advice, but I'm saying if you decide to do your banking privately and you want to use policy loans for investments, Well, when you do experience those payouts, those windfalls, okay, you sell the property, you increase your business revenue, whatever it is that you've done, where should profits go? Well, back into the policy. Now, here's a great question. What happens if you get to a point, because there is a point, where out of your profits, only so much can fit into the existing policy? There's a limit. It's called a MEC limit. You could watch a video on that concept in my encyclomedia series on my YouTube channel. MEC, Modified Endowment Contract. I can't remember the episode. Maybe it's 14, but you can find it in my encyclomedia series. Policies have limits, okay? And that's why it's so important, again, to have one properly designed and structured for you from somebody who's personally implemented infinite banking in their own lives, okay? If you go to a box store and talk to a box store insurance agent, you're not getting what I'm talking about. But if you've got more, well, then that begs the question of, is it time to open up a new branch, we'll say, of your family banking system? Don't the commercial banks open up multiple branches? Yes, and it's wild. I drove by a new bank the other day. In a town full of banks, I went by a brand new bank just the other day. Popped up on the corner. So if this was full, time to open up a new branch of the family banking system. Like I've said, me and my wife, to date, we have a system of 7 policies and counting so far, with a 4th baby on the way. Of course, our plan is to have another added to our system at the end of this year, 2025, at the time of this recording. We're waiting for a little baby boy to get here. And that's a great stepping stone into talking about legacy for me, because I got started seeing this concept when I was 30 years old. This would have been back in 2015. Yeah, because I just turned 40 this year. But our children got policies started on them much younger. So again, if you knew that you were going to experience, I don't know if I'm going to draw this the right way. Yeah. If you knew that you were going to experience a constant upward growth trend of your capital over your whole life, by having one of these assets, when would you want that to start? How big would you want the numbers to be? How many of those would you like to have? So our plan, of course, is to keep adding to our system as the family grows, business grows, our financial independence grows. So this has been something that I wanted to address because lots of folks have been asking me about this. I was on the phone today with somebody who says, Jesse, do you know what I mean when I say that I'm still working through some mental gymnastics around this concept? Like, he got a lot of it, has actually already started the concept, is considering getting a second policy. And I said, yeah, I know just where you're at. I can remember, getting my first policy, paying a premium, what for me and my wife was a significant premium at that time in our life, picking a significant number to us, paying premium, taking my first policy loan in 30 days or less, whatever it was, but it was less than 30 days, taking a policy loan and starting that debt payoff and realizing some things were just like it was described to me. This is really how it works. This is real. This is happening. But then there were still subsequent moments after that as we got more policies and we did more. We've done lots of different things. We've paid property taxes. We have helped finance family weddings. We have financed family vacations, business equipment. Actually, I'll be releasing soon a 10-year anniversary video about mine and my family's experience implementing this concept. So it is an exercise, this whole idea. Nelson says in his book, this is an exercise in imagination. He says it's an exercise in logic and reason, of course, and that's why I'm trying to just show you these concepts, show you these principles, and be an open book before you that you can have financial independence for yourself and autonomy. You can live and leave a lasting legacy through this concept. This is just our lifestyle paradigm now, and we are helping people all across the country to implement this concept. This has been a pleasure for me. If you have questions, I will get to those again, even in the replay. If you've not yet seen my introductory presentation, I think that's your next best move. If you are a client, we're already talking and working together, of course, and I look forward to our next conversation. Thanks for tuning in. Again, my hope is that you do live and leave a lasting legacy. I'll give this another few moments. I will be going live on Tuesdays to be able to field questions, share best practices. In this particular series, I've already released some videos on business implications of infinite banking, getting out of debt, and vacations. So you can find that live series where I have released those videos, but there's lots more information on my channel. But again, the starting point is going to be my full recorded presentation. Otherwise, you can book a free private consultation call with me at durhamtalents.com. I see that some folks are watching and listening in. I do appreciate you again. My hope is that you live and leave a lasting legacy. Have a great day. Take care.